Welcome to Market Briefs. Here's your daily market summary for May 15th, 2026. Stocks fell today, but the real story was a synchronized global bond rout that pushed yields sharply higher around the world. The S&P 500 closed down 1.2%, and the Nasdaq fell 1.5%. The volatility index, the VIX, jumped almost 7% to 18, elevated but not panic territory. Underneath those index drops, though, there was a fascinating split. Software stocks actually ripped higher. Figma was up 13%, Atlassian and HubSpot were up 8%, ServiceNow and Adobe were up 5%, but artificial intelligence hardware names got crushed. Cerebras, IonQ, and the Bitcoin miners and data center stocks all dropped 9 or 10%. That tells you this wasn't a uniform sell-off, it was a sharp repricing of duration. When long-term interest rates spike, the present value of multi-year capital spending plans gets recut, and that hits the data center build-outs hardest. Yields jumped everywhere. The US 10-year Treasury was up 2.5%, but that was actually one of the calmer moves. Italy's 10-year was up almost 5%. France and Germany both up nearly 4%. The UK up nearly 3%. Even Japan's 10-year jumped 3.3%. And Japan's bond yields are now at a fresh post-yield curve control high. This is a synchronized global repricing of term premium, not a US-specific story. And when Japanese government bond yields move this fast, we have to watch for carry trade unwinds, which can ripple through everything. Silver dropped 9% in a single day. That's a regime-grade move. Gold fell 2.4%. Gold mining stocks took it on the chin. Anglo Gold, Hecla, Kerr Mining all down 9%. Copper down 4.4%. The mechanism here is clean. When real yields spike, the opportunity cost of holding zero-yield metals goes up, and leveraged silver positions get washed out harder than gold. Within precious metals, gold outperforms silver. That's a classic risk-off within metals signal. Oil told a more interesting story. West Texas crude actually fell a touch, down less than 1%, but Brent crude jumped almost 2.5%. The Brent to WTI spread blew out by 47% in a single day to over $5 a barrel, moving into what I call the elevated zone. This is a real signal. It means global Brent-priced physical markets are tightening faster than the US shale-buffered WTI market. The likely driver is Middle East tension. There were several Iran-related headlines today, combined with OPEC plus production discipline. If this spread keeps widening past $8, expect downstream pressure on jet fuel, diesel, and fertilizer costs. Bitcoin fell 2.5% to about $79,000, dragged down by the same global macro rout. But the structural picture is more nuanced. The Federal Reserve's preferred inflation gauge, the Core Personal Consumption Expenditures Price Index, accelerated to 3.2% year over year, while the federal funds rate stayed flat. That means the real federal funds rate is now only positive 0.44%, barely restrictive, and it's compressing fast. This is what I call stealth easing, and it's structurally bullish for Bitcoin. The ratio of Bitcoin to gold is still trading above its weekly 21-period exponential moving average. Bitcoin is winning the relative race against gold, even on a brutal nominal day. But near-term, the on-chain data is genuinely worrying. Over 85,000 Bitcoin flowed onto exchanges in the past 7 days, and the spot Bitcoin exchange-traded funds saw nearly $11 billion in outflows over the last 2 days. That's real institutional distribution overwhelming a structurally bullish macro setup. The tension between those two forces is the story. Here's the most important read from the whole day. Credit spreads didn't blink. High-yield spreads actually tightened by 2%. Investment-grade spreads were flat. The Chicago Fed's Financial Conditions Index loosened. Money supply is still expanding at over 1% a month, and the Fed's balance sheet quietly grew again this week. So, This is unambiguously a rates-driven equity sell-off, not a credit-driven one. Financial conditions are easier than they were a week ago. That matters because when credit stays calm during an equity drawdown, dip buyers eventually come back once the rate shock stabilizes. The sector map confirmed the duration story. Software and cash-flowing technology led, with Figma seeing 4 times its average volume on the rally. That's real conviction. Energy stocks led on the long side too, confirming the Brent move. On the losing side, gold miners and AI hardware and quantum computing and crypto miners all collapsed together. The volume on the losers was lighter than on the winners, which suggests forced unwinds on extended longs rather than fresh fundamental selling. The big event ahead is the Federal Open Market Committee minutes on Wednesday, May 20th at 6 p.m. Eastern. With inflation accelerating and the long bond market freaking out about term premium, any hawkish surprise in those minutes could extend today's move. A dovish read, acknowledgement that growth is softening, would relieve the duration trade hard. Also watch the S&P Global Purchasing Managers Index flash readings on Thursday for early hints on services and manufacturing momentum. That's your Market Briefs daily summary. Like and subscribe for tomorrow's update. And remember, this content is for informational purposes only and is not financial advice. Always do your own research.